Okay, so after plenty of speculation in the run-up to the spring statement about government spending cuts, changes to ISA limits, tax changes and so on, today I wanted to share the key updates on this channel. We'll touch on some economic data which also came out today, along with I also want to talk about how financial markets reacted as well. So I spent about half an hour listening to what Rachel Reeves had to say, so let me give you guys the download. Arguably one of the biggest things on the top of savers' minds right now, myself included, was all of the speculation around the potential change to the cash ISA limit, with the potential to reduce that £20,000 ISA allowance per tax year, which is obviously spread across all of your ISA accounts, down to £4,000 just for the cash ISA. I guess almost to mirror that of what you see for the lifetime ISA. The reason why this has been speculated to reform the cash ISA, and I'm going to quote an interview which Rachel Reeves did with the FT, where she went on to say, "We want to continue to support cash savings whilst earning better returns for savers, boosting the culture of retail investment and supporting the growth mission." So it kind of appears to be a case where the UK government want to push cash savers more towards investment products. I've certainly got my own views on that, but thankfully in the spring statement that was just made, there were no changes announced to the cash ISA limits. But it could still happen later on this year, but it potentially won't be revisited until the autumn budget. And just as a reminder, we are about a week away to the end of this tax year, which is on the 5th of April, where everybody's ISA allowances reset. And it is a case of use it or lose it, so you might want to look at your own finances during the next few days to make sure that you're keeping your money in the most tax efficient places as possible. So now you know that, and that there were no other tax changes that were announced, hopefully you can now sit back, relax and enjoy the rest of the video. On the government spending front, the Chancellor's restored what's called the fiscal headroom at £9.9 billion in 2029-2030. This means that the budget deficit, which is projected to be at £36.1 billion for 2025-2026, will move towards a surplus of £9.9 billion, as I said, by 29-30. Obviously, that's a positive position to be in, but given the current circumstances, that's about as much headroom as sitting in the back of a Fiat 500. During the statement, I lost count of the number of billions of pounds that were being referred to, but the reality is 9.9 billion quid is kind of like a drop in the ocean when you think about it, especially when you contextualise that with current UK government debt levels being about 2.7 trillion pounds. Even the Office of Budget Responsibility report states that the headroom of 9.9 billion against the fiscal mandate is only 1/3 of the average of 31.3 billion pounds that chancellors have set aside against their fiscal rules since 2010, making it an extremely small margin for error and quite a big risk actually in the current economic circumstances and all of the uncertainty that we find ourselves in. However, there were lots of spending cuts and also spending increases which were announced. However, it's almost like kind of moving money out of one pot into another in order to try and stimulate economic growth. However, for me, here are a couple of the key ones. The first one being the additional £1 billion being proposed to be spent on helping young people specifically get back into work. Hopefully I'm going to quote this correctly, but I think Rachel Reeves said that 1 in 8 young people are either not in work, not in education, or any kind of formal training. And as a result of that, I think it's really important that we try and help that 12.5% of young people get back into the workforce, or just get into the workforce full stop, in order to help them reach their potential and also contribute to the economy too. Another one was on the housing front, where she confirmed due to planning reforms that house building here in the UK will actually rise to about 40-year highs, with the additional increase in housing or new housing stock being built at just over 300,000 houses a year until the end of the forecast period. That's obviously substantially higher than the amount of new houses being built right now, which was about 225,000 homes in 2024. I do hope this change helps first-time buyers in some way. I just kind of hope it helps the housing market situation just more broadly. However, the kind of inner skeptic in me thinks that this amount of housing stock still probably won't be material enough to make a hugely positive difference. I looked up what the actual housing shortage was here in the UK, and I did stumble across a report from 2023 from the Centre for Cities, which said at the time, bear in mind this a couple of years ago now, that the housing shortage was 4.3 million homes. And of course, that was then, and we're only now thinking about adding an additional 1.3 million homes between now and 2030, by which point there's going to be even more demand on UK housing, and that 1.3 million homes that we've built will still be nowhere near the amount that we actually need in order to recover from that shortage that we have. The other one that stood out to me was that the Labour government plan to clamp down on those avoiding paying tax, and hopefully that should raise an additional £1 billion for those committing tax fraud. The UK government planned to achieve this through investing in cutting-edge technology for HMRC. This will help put more money rightfully back into the pockets of the UK government to hopefully be spent in a way that will benefit us, the people that do actually pay their taxes here in this country. What else stood out to you though? Be sure to let me know down in the comment section below. Alongside the statement that Rachel Reeves came out with today, there are also a couple of other extra bits of economic data which I wanted to touch upon. First up, we had inflation, which was announced this morning by the Office of National Statistics, and it actually came in slightly cooler than expected at 2.8%, which is positive because it was below analyst expectations. However, it is still a little bit higher or a little bit above that of the Bank of England target inflation rate, which is just 2%. Now, personally, I don't really like the fact that we only ever really focus on CPI, which is Consumer Price Index. And actually, we kind of tend to exclude or not necessarily talk about something called CPIH, with the H being the bit that includes housing costs, so things like your mortgage, your council tax, and we all know that they've gone up, things like insurance, renovations and maintenance and all that kind of stuff. Generally just the costs associated with home ownership. And this figure is much higher at 3.7%, represented by the kind of dark blue or black line. And it's been steadily on the upward trend for about 6 years. It does kind of skew the numbers slightly, especially when it's something that we don't necessarily talk about, especially as housing costs are one of, if not the biggest monthly expenditure that we possibly all have. And as a result, I think it's an important talking point when it comes to our own personal finances. Going back to CPI though, the only thing that seems to have materially changed is the difference in clothing and footwear. Now, if I'm honest, I suspect that this is only as a result of like January and February sales where companies are looking to put stuff on sale to get rid of old stock and then replenish that stock with new stock ready for the summer. Other than that though, it's all really a much of a muchness in terms of changes. But what did change was the Office for Budget Responsibility's outlook for the UK economy, and if I'm honest, it doesn't look that great. Currently, UK economic growth rates are quite underwhelming, and they have been for quite some time now. The Institute for Fiscal Studies actually wrote a report around about the middle of last year, which was headlined "Low Investment, Policy Mistakes, Political Instability and Brexit have combined to hold back growth by more than in many comparable nations." Those comparable nations stated are the US, the EU 27, which is just the EU member states, and they've also singled out Germany too. And they've referenced the 2008 financial crisis and thereafter being kind of the point where growth rates really slowed down and never really quite recovered. And that's probably a fair conclusion if we look at growth rates pre-financial crisis in the kind of late 90s up until the financial crisis in 07-08. Visually, you can see they're higher, but as an average over a 14-year period, it comes out to just over 3%. If you then move past 08 and 09, where the economy starts to recover and we start to see growth again, those average growth rates during that next period were just under 2%. Then if you move past the post-pandemic stuff, which is kind of where we are now, economic growth rates pretty much flatline in 2024 at just 0.1%, where we haven't seen trajectories of growth rates being that poor since the pandemic and the financial crisis. Now, in terms of where we go from here, well, as I've said, the Office of Budget Responsibility did post a report today alongside the announcement that came out from Rachel Reeves. And despite how upbeat Rachel Reeves was about the statement that she was making, the report, on the other hand, might not make things out as so great as they might seem. From a growth perspective, the OBR downgraded growth forecast further for the UK, suggesting we'll see a growth rate of 1% in 2025 instead of the 2% which was previously forecasted in the autumn budget. However, I will caveat that by saying that actually growth rates thereafter, so 2026 and beyond, were actually upgraded in terms of those growth forecasts. On inflation, well, they've projected an inflation rate of 3.2% in 2025. From a labour market standpoint, they've said nominal earnings growth is anticipated to ease from 4.7% in 2024 to 4.3% in 2025, indicating a deceleration in wage increases. So that's not an overall decline in wages, it just means that wages will rise, just not as quickly. However, the OBR did state that people will be £500 a year better off by 2029-2030, which, let's be honest, is better than it going completely in the opposite direction. But then having said that, it's probably still not enough for your average working family, given all of the cost of living pressures that we currently have. So how exactly did financial markets react? Well, if I'm honest, the FTSE 100 was pretty flat and kind of still is as a recording. We did see some micro moves as the statement took place, where we saw an initial drop in the FTSE 100 after Rachel Reeves announced a cut in the growth forecast, but then it did jump back up as she then went on to say a few minutes or so later that those growth forecasts were going to be higher for the subsequent years thereafter. But then it did creep back down again as the news settled in for UK investors. But I'm intrigued to know what your thoughts are on the future of the UK stock market based on the current forecasts for the economy over the course of the next 5 years. That's a rundown of the current state of play here in the UK. If you did enjoy the video, be sure to subscribe to the channel. As well, if you do want to know what's going on in the US, then be sure to check out that video next. With that being said, I'll see you over in the next one.